Well, let's talk now to Timothy Ash, who's an economist at BlueBay Asset Management. Good to have you back on the programme, Timothy. So any expectations that President Erdogan would reverse his unorthodox approach to the economy seem to have rather gone out of the window if this recent rate rise is anything to go by?
Well, it's a bit mixed. I mean, he was cutting rates and wanting rates lower. The central bank has hiked rates. I mean, 650 basis points plus another 250. That's fairly significant, but it's not enough. I mean, inflation is 38%. Policy rates are now 17.5%, massively negative real interest rates. And in the end, if you're serious about fighting inflation, you need to have positive real interest rates. And the danger, they're vulnerable because they've also got a very large negative net international reserve position. They need to rebuild reserves, and given this move on the interest rate is very modest, there will be continued pressure on the exchange rate, which makes it difficult to rebuild reserves.
So inflation at 38%, the central bank wants to bring it down to 5% in the medium term. Is that simply unrealistic?
Well, medium term, I mean, if the medium term is between 1 and 5 years, maybe at the end of the 5-year period, it's possible. The last time the central bank met its inflation target of 5% was in 2011, 12 years ago. They're a long way from that. Expectations are that inflation in the short term will increase from 38% to maybe 50 or 55%, because we've seen a big exchange rate weakening since the elections in May, and that there's going to be more exchange rate pass-through. So, the market's kind of disappointed. They expected more. The message they're selling from the central bank is that they don't want to shock the economy with a much more aggressive rate hike, and they think they can do it gradual. There was a big Middle East support package for Turkey announced yesterday, $51 billion from the UAE, and maybe that makes them confident that will provide something of a buffer and give them a bit of room to a bit slower in terms of the monetary adjustment.
So you talked about the exchange rate. We saw the currency, the Lira, fall after this interest rate rise announcement. What are the prospects for the Lira in this current economic climate?
Well, the next couple of months may be a bit better. We're into the tourism season. The current account probably will be in surplus. But with massively negative real interest rates, foreign portfolio investors are certainly not going to invest in Turkish assets, so there won't be a foreign bid for the Lira. And as I said, they need to rebuild foreign currency reserves, so that will create their own demand for FX to rebuild those reserves. So, I think the pressure will still be downward on the Lira, a pressure towards depreciation, I think, to year end.
Timothy, good to talk to you. Thank you for joining us. That's Timothy Ash from BlueBay Asset Management.